QI watchlists are a way to quickly check in each day to see which of your investments are in a macro regime and whether there are any dislocations, whether any security is trading rich or cheap versus the prevailing macro environment. In this occasion, we start by looking at US equity ETFs at the sector level. Each time you can see model confidence. The higher the number, the better. A high number denotes that macro variables are doing a good job of explaining price action. And then here we see valuation. The white vertical line is macro warranted fair value. So you can see anything to the left is cheap to model, anything to the right is rich. So you can immediately see the bookends. OIH, the Van Eck Oil Services ETF, is just over one standard deviation, which is almost 10% below macro fair value. You can see the key drivers. Here, red denotes a negative relationship, green means positive relationship. You can see if we scroll to the bottom, ITB, for example, is the richest of the US sectors at the moment. In QI, by right-clicking on any model name, you can then open up that model in another tab, leaving the original watch list open. So we've now clicked on the iShares Home Construction ETF. This is the model for it, and you can see more detail for a deeper dive. Model confidence is below the threshold for a macro regime, so any signal therefore comes with a health warning because other factors, non-macro factors, are also helping explain the variance of ITB. It is currently 1.1 sigma, which is nearly 5.5% rich to macro fair value. How does that sit within its own historical range? Towards the top end. So if we were in regime, this would be an interesting signal. And here we can see model value in red and white is the spot price. So this is the valuation gap opening up. Spot price has moved ahead of macro fundamentals, albeit macro is also moving higher. Watch lists can be sliced and diced as you see fit. So if looking at US sectors on an outright basis isn't sufficient, and then you want to look at the relative value, you could draw up a watch list that looks at the same universe, but this time looking at it versus the broader market. Here you can see that financials are the cheapest at the moment. They are 0.7 standard deviations, or just shy of 2% cheap versus the broader market using the SPY ETF. And interestingly, at the bottom end, the richest is once again home construction, ITB versus SPY. So again, let's right-click and open up the model page, and then we can do a deeper dive into the dynamics of home construction versus the broader tracking S&P 500 ETF. Again, slightly below our threshold, so just out of regime. So this 1.1 sigma, or 4.5% rich valuation, comes with a health warning, even though it is towards the top end of the range. What are the key drivers? Why does ITB outperform SPY? It needs stronger growth globally, China, and commodities, iron ore. It wants rising real rates, a steeper yield curve. It wants a weaker dollar, and it needs risk on with lower VIX and other measures of risk aversion. These are the drivers that help you understand the macro anatomy of any given asset that you are trading. And the customization of watch lists go on. If you want to look at thematic ETFs, we can see here that we have FinTech, for example, trading as the cheapest of the thematic ETFs at the moment. The two ARK funds, both ARK Innovation and ARK Genomic Revolution, are around one standard deviation. And despite all the micro reasons, the stock picking for disruptive innovation that go behind picking the constituent parts for the ARK funds, they're both in strong macro regimes. Down at the bottom end, you can see the effect of the Biden infrastructure bill. Infrastructure ETF PAVE, TAN, the solar powered ETF, and Clean Energy, ICLN, are all the three that are on the rich end of things. And while we're talking ESG, you can customize still further. Another watch list just looking at ESG ETFs. The QI framework, and watch lists in particular, give you a way to monitor the assets that you hold. You can either check open positions for exogenous shocks that to date have been blind spots for you, but it also presents a pipeline of potential new trade opportunities.